A very good morning to all our viewers. You've tuned in to Opening Bell right here live on Money Control. I'm Stacy Pereira and I'm here to take you through all the news and cues that you need to be looking out for that could go on to impact your trading day. So let's just first set out the trade setup that we have for you, and it seems like Indian equity markets are poised for further corrections, at least maybe not in the coming day, but at least in the weeks to come, because the GIFT Nifty right now is indicating a positive start, maybe a gap up for that matter, but will it be able to sustain those levels is what remains to be seen. Close to 0.5% gain is what the GIFT Nifty is indicating right now. But globally, if you see across, we saw Wall Street futures, which are also trading higher at this point. This post the boost that it got from Netflix. That's because the OTT platform Netflix has gone on to add 13.1 million subscribers in this previous quarter. It has beat its revenue estimates as well, so giving the Nasdaq futures at least quite a bit of boost, those earnings coming in from Netflix. But if you look across in Asia, those markets are trading a bit lower as investors are assessing the trade as well as factory activity data that is coming out of Japan. But if you have to look at what the institutional investors are doing, and back home here yesterday we saw a flight away of outflows coming in from FIIs, where they continue to be net sellers for the fifth day now in a row. FIIs sold shares worth 3,115.39 crore rupees according to the provisional data that is put out by NSE, whereas DIIs tried to be, the buyers there brought about just 214 odd crores on Jan 23rd. That's the setup that we have and what we're looking like. Maybe FIIs continue to be elusive, but what could be the reasons? One, we did see after HDFC earnings, we did see a huge outflow that came in for that particular stock and also from the market as a whole. But in key earnings that we need to be watching out for today, we have Bajaj Auto as well as TVS from the auto pack. There's also Tata Steel, Tech Mahindra from the mid-cap IT space, as well as Canara Bank, DLF, Indian Oil Corporation, all of them reporting their Q3 numbers today. But let's also take you through some of the F&O cues that we are tracking. And if you have to go by the ban list, there are about 5 stocks that are placed in the F&O ban list for today, whereas NSE has gone on to retain Balrampur Chini, IRCTC, National Aluminium Company or NALCO, Oracle Software, as well as RBL Bank, which continue to be in the ban list, whereas NSE has removed Aditya Birla Fashion and Retail, Delta Corp, Indian Energy Exchange, Polycab, Sale, as well as Z Entertainment have been removed from that so-called ban list. Taking you through the put-call ratio and where the Nifty put-call right now, which pretty much indicates the mood of the equity market, and we can see that it's fallen back to that 0.74 levels versus the 0.86 that we had seen previously. And remember, below 1 PCR really indicates that traders are now buying more call options rather than put, which generally indicates, at least for the futures, a bullish sentiment. But of course, we are just on the penultimate day to that F&O expiry that we're going to see pretty early in this month. So we need to figure out whether it is that trade, that profit booking that is really taking place, at least because we are so close to this expiry and we want to finish off with the January series. But let's get going and discuss some more stocks and strategies, and joining me for that is Rajesh Palviya. He's the Senior VP Research at Axis Securities. Good morning, Rajesh. Now, well, we do expect some bit of pullbacks from these current levels. 21,000 is what we're seeing, and it could also go below to that 20,800 area. But it seems like the bears seem to have tightened their grip. And would you say that, are we seeing this lower highs, lower low formation, and that is what is really playing out? And what are the levels one should be tracking today?
Morning, Stacy. Yeah, so it was intense selling pressure in previous session. Both indices have slipped and both have witnessed a long unwinding kind of data setup on the derivative front. Looking at the structure for Nifty now, Nifty slipped below to 20-day moving average, and now it's approaching to its 50-day moving average. So looking at the overall structure for market, we believe that further more pressure is likely to be there for Nifty in coming trading session, as we have broken the important support area of 21,500. So if we continues to remain below to 21,500, then possibly yes, we can slip to the level of 21,000 and below also. So a sell on rise should be the strategy at this moment for Nifty until Nifty not manages to cross and close about 21,450, 21,500. Our lower target is around 21,000 on an immediate basis for Nifty. So to play this down move of Nifty, we are initiating here to buy put option of 21,200 strike that was closed at around 111. You can buy this put option in range of 111 to 90 rupees. Keep your stop loss of 55 and upside target for this put option could be towards 150 to 160. If you talk about the Bank Nifty also broke its important support area of 45,500. And for this series, almost Bank Nifty is down by around 7.5%. That is a clearly showing that Bank Nifty may show further more pain in the coming trading session, as now Bank Nifty slipped below to its 50-day moving average. And looking at the data setup, we believe that further more pressure is likely to be there if he remains below to 45,000. We are projecting target towards 44,650 on the downside for Bank Nifty. So a sell on rise strategy for Bank Nifty also until the Bank Nifty not manages to cross and close above 45,500. So this is the strategy for Nifty. Should I go with my stocks or?
No, in fact, we'll talk about the Bank Nifty specifically, because a lot of this sell-off that has happened, one could say, could attribute it to HDFC Bank and what came from that. So in this particular stock, what should one really observe that strategy? Because it is broken below its October lows, has plunged almost 3.5%, one would say, a lows closing that it saw in October. Now, this stock particularly, what one should take the strategy, has it moved below that level that one could actually see a buying opportunity, or one should really be waiting it out?
So for January series, a very intense supply pressure for HDFC Bank, almost down 16.5% for this month. And looking at the structure, yes, as you mentioned, stock broke its previous swing low. So looking at the structure now, if it continues to trade below 1460 mark, then possibly stock may slip further towards 1365 to 1360 kind of level. That is the next support area based on the technical structure that was low in the May 2022. So I think looking at the overall short built-up setup and looking at the near-term, short-term structure on the technical basis, we believe that further more supply pressure is likely to be there. So I think one should wait for another 3-4% kind of corrective move in HDFC Bank. Don't be in a hurry to buy at this moment, as a whole banking space is looking weak, and we believe that further more supply is likely to be there in banking space. So one can start buying around 1380, 1360 kind of level in a staggered manner. Don't go in a one go. So I think staggered buying is the right strategy to buy and accumulate this stock in this decline.
So buy and accumulate on the decline, and Rajesh has given us those levels that we could watch out for HDFC also. Rajesh, one more sector rather that I would want to point out now is the pharma sector, especially because yesterday, at least what we saw. Okay, let's first address the market open and then get to the sectoral movers that we are going to look at. But there on your screens, market pretty flat, one would say, just about 0.09%, 0.1% down there for the Nifty. It was pretty much what we were seeing, hoping that the gift Nifty was actually pretty much wrong on this counter, we would say, because we were looking at a good positive start on the gift Nifty, which it was indicating, but we are seeing some bit of pressure continue. One could say what we're getting from the Asian counterparts are also pretty much in the red at this moment. So the Nifty also succumbing, or rather that pressure continuing, going down to that 21,200 levels. Let's also check the other sectoral movers and what the other benchmarks are really doing. Bank Nifty there again at that 44,800 odd levels, 850, but about just 0.3% lower there. So Bank Bank Nifty also pretty much continuing that downward trend, we could say, and like we were pointing out, perhaps more pain to come. Broader indices, though, have been at least tried to be the outperformers compared to the benchmarks. But here you can see the Nifty mid cap as well down and about in today's trading session. Let's look at what the other small cap as well. Small cap trying to hold out there. Like I was saying, pretty much the mid and small cap have been the ones that are, trying to get some bit of relief, one would say. But is that the right strategy to play? We'll be discussing that. Nifty IT holding out there, almost close to 1%, one would say, 300 odd points up. So the Nifty IT index is a positive in today's otherwise red session. Nifty Auto seeing some bit of pressure there, 0.5% lower, but that's ahead of its earnings. We're seeing Bajaj Auto as well as TVS Motor come out with their earnings today, so we're going to see that back. Nifty Pharma, another one there looking in the red. Yesterday it was the only one perhaps in the green when we saw such a big sell-off, but the pharma index now they're also succumbing to those pressures and in the red. FMCG 2 in the red, just about 1/10 or lesser than that, but consumption story is something that people are pretty much betting on, at least in the run up to the elections, and that's how we are seeing it also play out. So those names perhaps in these baskets or in these indices really holding out. Nifty metal there being again other than IT, also seeing metal almost close to 1% higher. So the Nifty metal pack also trying to hold out today and give you some bit of semblance. Realty taking a hit. Even yesterday it was the one of the biggest losers, and now you're seeing the realty index almost 1.5%. They're down. This again you could say some bit of involvement from the earnings that we're seeing. We saw Oberoi Realty yesterday. Today we have DLF anticipating and coming out with its earnings. So pretty much that count also down about. But let's also look at who's really contributing to these gainers and losers. On your screens now, the top gainers that we're seeing at this hour: Hindalco, HCL Tech, Infosys. So most of those IT counters, because we did see the IT index there in the green. So Wipro, Tech Mahindra, Coal India, all of your IT names pretty much making it to the top there. Adani Enterprise, SBI, as well as IndusInd Bank. So some banking names also among the top gainers. But let's look at top losers then. And what's really putting the pressure? Axis Bank, of course, after those earnings, and pretty much what we've been talking about the banking pack as a whole, whether it is the right time, there is more supply, like Rajesh was pointing out some time back, and we could actually wait to then enter into the banking names. But Hero MotoCorp, Sun Pharma, Hero Motor surprising there because it just came up with a launch in its premium segment of bikes, and they are hoping for more on the same lines. Sun Pharma, another pharma counter there that is in your top losers. Bharti Airtel, Asian Paints, as well as Grassims, they're making it to the top losers list. Tata Motors, Power Grid, as well as Maruti Suzuki. So a couple of auto names that we are seeing in the losers list, whereas in the gainers list, it is of course the IT pack. So we are pretty much getting a sense of where the selling pressure is really coming in from, and where they are trying to hold out and wait, pretty much give that momentum, rather we would say, to the markets. But let me get back to Rajesh and get his sense of which are the sectors one should be looking at least to be trading, if we're talking about intraday trade, also maybe for a long-term strategy. Right now what we're seeing, the IT pack, perhaps the earnings not so much to give it cheer, but could we now be collecting that in our portfolio, as well as the auto? What would be the strategy for these two particular sectors at least?
So I think auto one can look to buy and decline, because as overall structure for automobile sector is still on the bullish side. Yes, there is a corrective action is going on, but we believe that once this supply pressure settle down at certain point, I think automobile is a sector where again buying interest is likely to be there, as most of the stocks are enjoying their breakout above their on the long term chart. So I think from that space, Tata Motor is one stock where one can look to buy this stock in this decline. I think if you get opportunity to buy around 770, 760 zone, it's a good level again to re-enter in Tata Motor in the decline from automobile space. And then another stock that we like is Mahindra and Mahindra. These two stocks one can look to buy in the decline. Again, from IT space, yes, there was some momentum was there in last couple of week, but still again from large cap IT stocks, there is again supply pressure is taking place. On from large cap IT, we do expect that TCS may show some strength in this IT pack. So one can look to buy this stock if you get any opportunity around 3800 or 3770. So it's a good level again to re-enter in TCS with stop loss of 3740. And on the high side, once stock crosses above 3940, then possibly we can see target above 4040 kind of level in the TCS. But if we go with the mid cap IT space, yes, some of the stocks are doing good, and I think Birlasoft would be our preferred choice in mid cap IT from that space. And one can buy and accumulate this stock as the overall structure for Birlasoft is on the bullish side. So these two stocks are looking attractive from IT space at this moment.
I was going to come to you about mid-cap IT. Today, we are going to see earnings of Birlasoft as well as Tech Mahindra. And that pretty much gives you a sense of, whether there is such a dichotomy between our large-cap IT and what we are seeing there and what the mid-cap rather is doing. So, should one then use that kind of a strategy where you look at the smaller players and see momentum or their growth compared to the large caps?
Yeah, I think yes. So outperformance would be there in mid cap IT space. So I think instead of buying a large cap, I think mid cap IT is likely to perform well because most of the mid cap IT stocks are enjoying their breakouts on their short to medium term structure. So we believe that one should focus more on mid cap IT rather to play on the large cap IT.
And finally, Rajesh, like I was pointing out before, the PSU names are the ones that are seeing some great rally, at least if you look at just basic your the railway stocks. So when it comes to a couple of defense names, of course, this is in the run up to the budget and these sectors are expected to, have this kind of momentum. But is this just a short-lived rally, or do you think PSUs, and in particular, which of these PSUs one should be looking out for?
So I think defense stocks are in structural bull run. Yes, some corrective move is happening, but overall, I think nothing to worry in terms of trend of defense stocks. So I think one should ready to deploy again, their investment for defense sector. And railway stocks, yes, we have seen a very sharp run up in last couple of weeks. So maybe some corrective move would be there. But again, if we analyze the overall structure for railway stocks like IRFC, IRCON, or Titagar Vegan or some other stocks. So these all stocks are showing very strong buying action across all time frame. So I think again in railway pack also this is an opportunity again to buy and accumulate in this corrective move. I think this rally is likely to continue as overall bullish sentiment towards railway theme, which is playing out, and the kind of infra spending which government is doing on this railway. So that clearly shows that a lot of traction is going to be continue in the railway stocks. Yes, could be valuation, could be a little not justifying the prices, but still the kind of buying flow is taking place in these stocks. So on a technical ground, yes, we do have bullish view for these railway stocks. IRFC is our preferred choice at this moment. I think if you get opportunity to buy around 155 level, that's a good level again to re-enter. Keep your stop loss of 145, and we are projecting target towards 190 to 200 for IRFC in a positional basis.
Right. Quickly, Rajesh, for our viewers, what are the stocks that you have on your radar for today? What are your picks?
So I think Bharti Airtel one can look to buy as a clearly outperforming stock throughout the series, and looking at the overall structure, we believe that towards the expiry, this stock can continue furthermore upside. We are projecting target towards 1190. So Bharti Airtel one can buy with stop loss of 1130. And another sector that we like at this moment, that is pharma, and from that space, Sun Pharma is looking promising. Overall structure is bullish. Stock is almost enjoying its all-time high trajectory. We do expect this upward momentum likely to continue. 1420 is our next target for the stock on trading for trading perspective. Keep your stop loss at 1345. And one stock where we feel that pressure could be there, that is Jindal Steel and Power. stock broken its a 50-day moving average. Looking at the data setup, we believe that Jindal Steel and Power can go down. So one can go short for downside target of 670. Keep your stop loss of 710.
Right. So interesting picks there that Rajesh has for us. Let me thank him then for giving us those interesting perspective on the sectors and how we should be trading, and also for those recommendations that he's given. And thanks so much for your time, Rajesh. Let's also now shift focus towards the fundamental side of the picture. And if you have to look at it, pretty much we would say the stars are aligned for India in terms of the macro perspective. But how much of that is really translating to our markets? And of course, we do stack up compared to our peers. We do look like an interesting market to be investing in, but that has not stopped FIIs from really fleeing away, one would say. Now, there could be different reasons for that, and we are pretty much going to be dissecting what could perhaps be the reason for this. So is it just, those jitters ahead of an election or a budget, or are there bigger macro headwinds, not just in India, but globally that could impact even India? And let's discuss all of this with Feroze Azeez. He's the Deputy CEO at Anand Rathi Wealth. Good morning, Feroze. Thanks so much for speaking with us here at Money Control. I was just setting out the picture. We seem like we have a good fundamental story to be talking about, but the markets perhaps are not correlating at this point. Now, this could be, are our valuations overstretched? Are we getting ahead of ourselves? What really would be, if you had to point out could be the reasons why we're seeing such a big of FII outflow, at least in the past few days?
Hi, Stacy. Good morning. So firstly, like you said, there's so many things which you said. Let me try and dissect each of them. When it comes to correlation, expecting the markets to be correlated to the equity or to the macroeconomics in the short term may not be a fair assumption. If you look at it the long term, does the capital market correlate the economy? It certainly does. Let me give you some data to prove this hypothesis. If you look at the years 2001 to 2012, the GDP growth, the nominal GDP growth was close to about 13.6. Nifty growth was 14.9. The subsequent 11 years, 12 to 23, the nominal GDP grew by 10.9. Nifty grew by 11.4. If you look at this 22-year pocket in total, 12.3 was the nominal GDP growth and 13.1 is the Nifty growth. When you see all these three data points in isolation, two of them mutually exclusive data points of 11 years each, you would see that there's just about a 50 bips difference between the nominal GDP and the actual Nifty return. So point is, they are correlated in the long term. Now coming to the short term, I think we have not gone far ahead from where we were. From a valuation standpoint, I can't call it to be a very expensive zone. That's point two. Why do I say so is because if you look at the Nifty earnings, we started the year with 945 rupees of earnings estimate. That translated into something which we have now upgraded it to 965. So if on 820 rupees base, which is the last year's earning, 819 to be precise, you are growing to 960. That's a great growth. That's about 17-18% growth. So we have, if anyone sees the earnings of the last 4 years, on a sheet of paper from 530 to 770 to 820 to 965 and next year 1100, he or she would concur that markets have not gone overvalued because earnings have caught up with the prices.
Earnings have caught up, you're saying, but can we expect more correction in this current market? We are already looking at levels. We've come down to almost 21,000 from seeing those highs of, more than that. So are we expecting, at least in the coming weeks, to see some bit more of correction in the markets?
Yes, Stacey, I think markets, there are four things which or three things which are important to see, is when the base is larger. Now we are at 22,000. 1,000 points is different than when you are at 17,000 and 1,000 points. 1,000 points today is less than 5%. 1,000 points on a base of 1,500 is 7%. So the numbers are going to be larger. Like when you see Sensex, it falls significantly more in terms of an absolute number because of a larger base. That psychological recalibration every investor has to do when market levels change. Otherwise, you get perturbed too much by looking at points. So that's one. Point two, markets have this tendency to fall every single year. An investor with a 10-year investment horizon, or even 5, or even 3, will at least see 15% corrections if not more, at least 4 times in his 3-year period. If that's the nature of the beast, which is equity, that's why it gives you 3 times more than an FD return. If you mentally prepare yourself, in 3 years, you are going to see 4 times or 15% correction from the portfolio value you saw yesterday. Then you will not be so perturbed and you will not take emotional decisions. You will be more prudent in decision making. Third, the pace at which market falls is dramatically different than the pace at which market goes up. The number of 1% fall days are significantly greater than 1% up moves on a specific day. But the gravity of the market is always on the highest side. Like the Earth's gravity is down, a market's gravity is up. If an investor reminds himself that the gravity is up, betting against the gravity is not a great idea.
Right, so betting against the gravity, clearly not a strategy one should be using. But let's also address a couple of stocks which are on focus and a couple of earnings that have come in, and then get back to Feroze to get his perspective on them. I'm talking about Axis Bank because that clearly was, of course, in your top losers list. Now this because it has recorded only about a 3.7% year-on-year profit at coming in at about 6,071 odd crores, whereas the net interest income for the quarter just grew by about 9.4% at 12,532 odd crores. Net interest margin coming in just about 4.01% for the quarter. Asset quality front, one would say it has fallen. Net NPAs have fallen by 15 basis points. So you're looking at some bit of improvement in the asset quality, but overall bank numbers now, those are pretty much on. They've not really lived up to the expectation, we would say. And when we started this year out, we did think that, the banks are going to be the outperformers. But so far, if you have to look at it, perhaps maybe not living up to those expectations, one would say, and which is why you're seeing this huge outflows as well. But let me get Feroze's perspective and ask him about the banking sector as a whole. We've seen pretty much most of the private banks at least come out with their earnings so far. And most of them have missed estimates, one would say, although there are a couple of brokerages that continue to remain or have an outweight or buy call on these names, be it like Axis or ICICI Bank a day before that came out with a little bit, some bit of relief in terms of numbers. But overall in the banking pack, how would you really be, if you have to give a pecking order for them, especially for these private banks now, what should one be using, what should be the strategy and what should one be looking out for when you're, trying to add these to your portfolio?
Yes, Stacy, if you look at larger banks, I would say that what's so unique about larger banks from a demand supply standpoint, and of course earnings everyone knows, they've deciphered. I think one thing which stands out in my mind when it comes to the banking sector is Nifty has about 35% of weight in the BFSI. The topmost sector is that, and the second one is IT. If you look at 35% of Nifty, and these private sector banks, which you mentioned, are top 10 weights of Nifty. What happens when it comes to Nifty is that a lot of this free float is gobbled up by passive funds. And that's what is going to be the trend for the next 3-4 years. EPFO has a passive fund strategy, and EPFO has a few lakh more crores to deploy in the next couple of years. So what's going to happen is there is going to be buoyancy on these stocks. So if you're going to be looking at the banking sector to be the anchor of your portfolio, it's a great strategy. I don't think it will give you significant return, but it will reduce your risk over the next few years because it is going to be a liquidity-driven market. If the government continues, there's a lot of money outside the country waiting to come in. And if it so does, the first thing which happens is the top 5 stocks of Nifty get cornered for good. A passive fund does not give back the supply which it has taken away from the capital markets. So that's the point I'm trying to make. So these can be a very good anchor strategy for the next 2 years if you believe in a cash flow coming into India or liquidity coming into India, which I think is a larger probability. So that's how I would see this. Second, I personally think that in the banking space, the business models are reasonably divergent. They look very optically identical, but if you go down to the brass tacks, there are very, very different business models which are very well diversified. So I think combining a certain bank basket, which on a day-to-day basis are correlated, but on a 2-year, 3-year basis, if you look at their betas with each other, they're significantly low.
Right. Another sector that I would want your view on is the auto pack. Now, today, of course, the auto index is pretty much down and about, and we saw a couple of those names make it to the laggards, at least for early trade. But we do have earnings coming up for at least two-wheeler earnings, where we're seeing Bajaj Auto as well as TVS come out with its numbers. Just overnight, we did hear from Hero MotoCorp as well, and they've gone on to launch a couple of more premium products. So what really is the play, especially for two-wheelers? Because up until now, we always looked at them to be, whether it was the rural recovery that would really guide the numbers for the stock. But now we are going to the extreme end, and we're looking at premiumization and how these companies are now focusing there, and that's where they're seeing the sales numbers as well. So how should one really be looking at auto stocks specifically, and what would be your play for them?
My play for them would definitely be the rural demand still. Of course, some structural changes like these and market creations take their own sweet time. I think that you should still look at auto from a rural demand pickup hypothesis, and I think that is going to happen because the kind of back-ended expenditure by the government, which has happened in this financial year, is enormous. So when you look at 7 months number, which I correctly remember, is that we had only penetrated 44% into the fiscal deficit target. Fiscal deficit generally by 7 months is 73% penetrated. That's the long-term average. So there is a lot of back-end spending in this financial year, and that will transpire in a few months into the rural demand. So I would be far more bullish in their already established segment, not the premium segment, from a short-term standpoint. Of course, from a long-term standpoint, the kind of margins in the premium segments are significantly more, and that could definitely play out. But if you're a short-term player, I would still look at this hypothesis, and I think this hypothesis has a large merit to put some money on the table.
Interesting, because most of the people that we've been talking to have been talking about, consumption and discretionary consumption, and especially with premiumization taking place at such a large extent, they would see, or rather want more from these, at least two-wheeler companies. But yeah, of course, rural play will and cannot be taken away, and that is pretty much what will also be guiding these two-wheelers. Well, thanks so much, Feroze Azeez there from Anand Rathi Wealth, for giving us his perspective on the sectors that we need to be looking out for, and also the stocks which are pretty much doing the rounds today, doing a buzz in trade. Thanks so much, Feroze, for your time. Well, let's also quickly address a couple of more stocks that could be a buzz. One being Glenmark Pharma from the pharma space. This one too has come out with its numbers. We're seeing 13.1% year-on-year net profit growth coming in at 118 crore rupees. This mostly driven by the healthy operating performance. Revenue too for the quarter has increased by 5.9%, coming in at 572.8 crore rupees. That was Glenmark Pharma. Other than that, you could also look out for what has happened with CII. Now, CII has come out with a couple of approvals that it has gone by in this last overnight. In fact, we've seen the Competition Commission of India come out and approve the merger of FinCare Small Services along this with AU Small Finance Bank. So a little bit more, traction that you're going to see in the small finance space, because this merger has now been approved. Of course, it does wait a regulatory approval from the RBI. In fact, CII has also approved the 100% acquisition stake of Wistron Infocom by Tata Electronics. Now, none of these are listed players, but it is interesting to see, because Wistron, remember, is your main manufacturer for iPhone, for Apple phones in the country. So we are seeing that take place with Tata Electronic, and they are going to be acquiring Wistron from the SMS Infocom Singapore, which is the Wistron's Hong Kong holding as well, going to be participating in this. So it'll be interesting to see how this really turns out in terms of, our whole Make in India play, because now you're going to have a formidable player from Tata Electronics within this space. Well, it seems like we're completely out of time on this show, but the market's pretty much there, down and about flat, we would say at this point, but we're just a day ahead of expiry, so we could have expected and anticipated this kind of consolidation rather, or a correction in the coming weeks is not something that we could put behind us either. But from all of us that put this show together, thanks so much for tuning in, and do keep sending us your feedback in the comment section below, so that we can try and get you something new, something improved for all of our viewers. But for now, it's a goodbye and thank you for tuning in.